This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 8, 2026, and this is the New York session. Now, let's get into it. Bitcoin is stuck at $61,874, down 2%, while the Fear and Greed Index hits 14, deep in the extreme fear zone. We are watching a market where geopolitical shocks and a collapse in futures demand are stripping liquidity from the board, leaving altcoins like Solana and Cardano bleeding hard. Let's break down the mechanics of this sell-off. Turning to the schedule, there are no major macroeconomic data releases or central bank decisions scheduled for today. However, we are monitoring the progress of the U.S. Senate housing bill, which includes a CBDC ban and the Nasdaq listing pursuit by PayPay, the owner of Binance Japan. These are structural developments rather than immediate price triggers, but they remain on the radar as the market digests this week's volatility. The broader picture is stark. Total market cap is down nearly 2%, with $22 trillion in active capital facing a 17,000-strong universe of tokens. But the real story isn't just the price drop, it's the source. We are seeing a simultaneous collapse in Bitcoin futures demand and a massive non-market-driven liquidity drain linked to geopolitical tensions. The market is not just falling, it is being drained. Let's look at the headlines driving this. First, Cointelegraph reports that Iranian crypto outflows have spiked 700% following recent U.S.-Israeli airstrikes. Second, CoinDesk notes that Bitcoin futures demand has fallen to 2024 lows, raising questions about whether institutions are exiting the market. And third, CoinDesk reports that Core Scientific is turning lower after disappointing Q4 results. Let's get the impact on these moves. The Iranian outflow headline is the primary driver of the current sentiment floor. A 700% spike in capital flight creates a psychological ceiling. When traders know that sudden, politically motivated sell-offs are entering the market, they front-run the pump. That is why the Fear and Greed Index is sitting at 14. We aren't just reacting to price action. We are reacting to the threat of unanchored liquidity.
And that threat is becoming reality on-chain. The 700% spike isn't just noise, it's a confirmed off-exchange withdrawal event. We are seeing capital leaving offshore custodians for cold storage or jurisdictions outside the reach of U.S. sanctions. This means that exchange order books are seeing a net reduction in available supply, but because futures demand has also collapsed, there is no leveraged bid to absorb the spot selling pressure. It's a double whammy of supply shock and demand evaporation.
I'd add a warning on the Core Scientific headline. When a major miner like Core Scientific turns lower on fundamentals, it doesn't just affect the stock. It validates the high beta narrative for miners and related infrastructure plays. In a risk-off environment, hardware depreciation and energy costs become liabilities rather than assets. The market is punishing the entire chain of dependency, from the hash rate sellers to the tokenized yields built on top of them. That is a structural risk, not just a sentiment dip.
So we have a market paralyzed by geopolitical uncertainty and leveraged unwinding. Let's zoom in on the anchor, Bitcoin. Bitcoin is at $61,874, down 2.24%. Grid, what does the chart structure tell us about this level?
Technically, 61,874 is acting as the immediate pivot, but the structure underneath is fragile. We are seeing a clear divergence between Bitcoin and the broader market. While Bitcoin is holding relatively flat, Ethereum is down 2% and Solana is down 5%. The Ethereum/Bitcoin ratio is compressing, which tells me that capital is rotating out of speculative smart contracts and into the relative safety of Bitcoin, or simply out of the ecosystem entirely. Support on Bitcoin is thin. We haven't seen a sustained bid above the overnight high of 64,013. Any bounce here is likely to be met with distribution until that level is reclaimed.
Grid's observation on the Ethereum/Bitcoin compression aligns with the flow data. We are seeing a distinct retreat from alt-layer leverage. The futures demand for altcoins is dropping faster than for Bitcoin. This confirms that institutional players are deleveraging the beta trades first. They are keeping the core position, Bitcoin, and cutting the satellite exposures, Ethereum, Solana, Cardano. So while grid sees a pivot, I see a defense. The 61,000 level is being held not because of buying strength, but because selling volume has temporarily exhausted itself.
That distinction is crucial. Grid sees a technical hold, CIPHER sees a defensive retrenchment. But Pulse, you noted earlier that the sentiment is at a 14. Does that sentiment allow for a technical defense, or does it suggest the floor hasn't been found yet?
It suggests the floor is being tested. The 14 reading is at the extreme end of the scale, which historically correlates with periods of maximum pessimism. However, the 7-day trend rising from 12 to 14 suggests that the panic is stabilizing slightly, not because optimism is returning, but because the easy sells have finished. The market is now waiting for the next catalyst. Currently, the only catalyst left is the resolution of the Iranian outflow situation or a resumption of futures buying. Until one of those happens, the 14 reading is a static measure of dread, not a dynamic signal of reversal.
And let's not ignore the VIX. At 1557, traditional equity volatility is quiet. This makes the crypto fear and greed of 14 look even more isolated. We are seeing a decoupling. Equities are sleeping. Crypto is waking up screaming. That isolation usually means the risk is internal to the crypto ecosystem, specifically the leverage flush mentioned by CIPHER. When equities don't provide a hedge, crypto traders have nowhere to hide, which accelerates the liquidation cascade.
Let's move to Ethereum. Ethereum is at $1,739, down 2.03%. It's lagging Bitcoin, but still posting significant losses. What is happening to the Ethereum/Bitcoin ratio?
The ratio is weakening visibly. Ethereum is down 2% while Bitcoin is down 2%, but on a relative basis, Ethereum is losing ground against the dominant narrative. We are seeing lower highs on the Ethereum chart compared to Bitcoin. The key here is the volume profile. If Ethereum continues to underperform Bitcoin on increasing volume, it confirms that alt-season narratives are being discarded in favor of liquidity preservation. Traders are using Ethereum as a proxy for the broader alt market, and right now that proxy is failing.
From a flow perspective, this is clean. We are seeing stablecoin pairs dominate trading volume against Ethereum. Traders are swapping Ethereum for USDT or USDC, effectively exiting the risk curve. The lack of inbound stablecoin deposits into decentralized finance protocols suggests that the yield narrative isn't attracting capital during this downturn. Money isn't flowing into Ethereum decentralized finance, it's flowing out. That matches the drop in total value locked observed across major chains.
So Grid sees a technical weakness in the ratio, and CIPHER sees capital flight from decentralized finance. Pulse, does the sentiment data support this rotation away from Ethereum?
Absolutely. The risk-on component of the fear and greed calculation is tied to altcoin performance. Because Ethereum is dragging down the alt basket, the overall index is suppressed. Retail sentiment, as measured by social engagement and search trends, is shifting away from Ethereum development updates and toward basic survival queries. How to withdraw? Is the exchange safe? That behavioral shift directly impacts the demand side of Ethereum. It's not just a chart pattern, it's a change in user intent. Now let's look at the high beta casualties. Solana is at $76.83, down 5.41%. Cardano is at 16 cents and 66 mils, down 6.84%. These are severe moves. Grid, what do these levels indicate?
These are breakdown zones. Solana at 76.83 is well below the 20-day moving average, and Cardano at 0.1666 is approaching multi-week lows. The speed of the decline, 5 to 7% in a single session on high volume, indicates stop-loss hunting and margin call cascades. There is no consolidation phase here. This is a vertical washout, technically. This suggests that the support levels drawn from previous months are being vaporized. The market is pricing these assets as higher risk than they were 48 hours ago.
And here is the risk flag. When support levels vanish like this, we enter price discovery territory on the downside. Without established floors, algorithms will hunt for the next liquidity pocket. For Solana, the next logical level might be the 48-hour low, which would require a significant gap down. For Cardano, the lack of recent consolidation means there are few resting limit orders to catch the falling knife. This is dangerous terrain for any trader attempting to buy the dip.
CIPHER adds that the on-chain activity for these chains is spiking, but mostly in terms of failed transactions and network congestion due to the high-frequency trading bots that thrive on volatility. The utility layer isn't necessarily dying, but the speculation layer is burning. We are seeing a decoupling of usage from price. People are still using the networks, but they are refusing to pay the premium. This creates a fundamental tension that Grid's chart analysis captures perfectly. The price is leading the fundamentals down.
Amidst this carnage, there is one bright spot: Uniswap. Uniswap is at $3.28, up 3.74%. It is the only major cap in the top 10 to post gains. SPECTER, you mentioned this earlier. Why is Uniswap defying the trend?
Uniswap is benefiting from a flight to infrastructure narrative. As centralized exchange counterparty risk rises, with the Iranian outflows shaking trust in large offshore platforms and the core scientific issues shaking confidence in mining stocks, traders are rotating into decentralized exchanges. Uniswap represents a non-custodial solution. In a crisis of trust, self-custody wins. This isn't just speculation, it's a functional hedge. Investors are parking capital in Uniswap because it offers exposure to decentralized finance fees without relying on a centralized entity that could freeze funds.
And from a flow standpoint, Uniswap's TVL and transaction volume are holding steady while others drop. This confirms that the capital rot is structural. Money is moving from speculative tech, Solana, Cardano, to financial plumbing, Uniswap, Chainlink. Chainlink is down 4%, but less severely than the L1s, reinforcing this hierarchy. The market is rewarding utility that generates cash flow over utility that promises future scaling.
Technically, Uniswap is forming a strong ascending wedge on the hourly chart, separating it completely from the rest of the market. It is trading in its own universe. If this trend holds, it suggests that Uniswap is becoming a safe haven within the crypto ecosystem. However, I caution against assuming this momentum is sustainable indefinitely. Usually when one asset decouples this strongly, it either merges back with the trend or breaks out entirely. Right now, it is merging back slower than expected, which implies a slow grind upward rather than an explosive breakout.
So we have a clear dichotomy. Grid sees Uniswap as technically strong but potentially isolated. CIPHER sees it as structurally resilient due to infrastructure demand. Pulse, how is the sentiment around Uniswap different from the rest of the market?
It's neutral to cautiously optimistic. While the broader market is at 14 extreme fear, Uniswap-related discussions are centered on governance proposals and fee structures, not panic. That cognitive separation allows Uniswap to maintain value. When the rest of the market is screaming risk, Uniswap is whispering utility. That subtle difference in tone is what keeps the price green while everything else burns. Let's look at another casualty, Near Protocol. Near is at $1.87, down 7.02%. It is the worst performer among major caps. What is driving this severity?
Nearest is exhibiting classic low-float, high-beta behavior. When liquidity dries up, small-cap assets move the most. Near is down 7% while Bitcoin is down 2%. That threefold multiplier effect indicates that there are very few buy orders on the order book. A modest amount of selling pressure is causing a disproportionate price drop. This is a liquidity problem, not necessarily a fundamental one. Once the selling exhausts, the rebound could be sharp, but until then, the chart is ugly.
On-chain, we are seeing increased staking withdrawals from near validators. This suggests that early investors or large holders are taking profits or reducing exposure ahead of potential vesting schedules or simply to preserve capital. The combination of validator exits and spot selling creates a perfect storm for the price. Unlike Uniswap, which has organic fee revenue backing its value, Near relies heavily on network growth narratives, which are currently out of favor.
And remember the core scientific drag. Mining stocks often correlate with hash rate and network security assumptions. If miners are struggling financially, it puts pressure on all PoW and hybrid chains. While Near is PoS, The broader tech stock sentiment in crypto is tainted by core scientific's myths. Investors are questioning the profitability models of the entire infrastructure stack. Near is caught in that crossfire.
Finally, let's touch on Ripple, XRP, and Chainlink. XRP is at $1.08, down 3.83%. Chainlink is at $7.58, down 4.04%. Both are down, but less than the high beta L1s.
XRP is consolidating in a tight range. It lacks the explosive upside of Solana but also lacks the deep crashes of Cardano. It is a mature asset in this cycle, meaning it has fewer speculative levers pulling it around. It's boring, and in a volatile market, boring is good. Chainlink, meanwhile, is acting as a bridge asset. It's down, but it's holding above key support levels that are clearly defined. The chart shows accumulation patterns forming at the lower bound of its recent range.
Chainlink's resilience is tied to its role as an oracle service. Even when trading volume drops, the need for reliable price feeds doesn't disappear. Smart contracts still need data. Therefore, the fundamental demand for Chainlink remains intact, unlike speculative tokens. This provides a floor for the price, which explains why it isn't crashing as hard as Near or APT.
To synthesize, we have a market defined by a liquidity crunch. Bitcoin is holding at $61,874 solely due to defensive positioning, while futures demand collapses to 2024 lows. Altcoins are being liquidated en masse, with Near and Cardano leading the bleed. However, a rotation is occurring into infrastructure. Uniswap is green, Chainlink is holding, and stablecoin usage is surging. The geopolitical shock from Iran has added a wild card, draining offshore liquidity and amplifying the fear. The market is not broken, but it is hollowed out. We are watching a deleveraging event, not a collapse. Watch for the return of futures buying. Until that happens, the path of least resistance remains sideways to lower, with isolated pockets of strength in utility-heavy protocols.
Here are the key takeaways from today's pre-market. First, Bitcoin is testing the $61,874 level with weakening volume and collapsed futures demand. Second, high beta assets like Solana and Cardano are facing severe liquidation risks as sentiment hits extreme fear at 14 out of 100. Third, capital is rotating defensively into infrastructure assets like Uniswap and Chainlink, avoiding speculative smart contract platforms. Tomorrow, watch for any signs of stabilized futures volumes and monitor whether Uniswap can sustain its decoupled strength. Stay alert, manage your risk, and keep your eyes on the flows. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.